November 2024. S&P 500 hits all-time high, 6,100. NASDAQ at 20,000. Bitcoin at 98,000. Real estate up 40% since 2020. Stocks, bonds, crypto, housing, everything rising together. Financial media celebrates best time to invest. Don't fight the rally. New paradigm. But three metrics tell different story. Stock valuations highest since 1929. Total debt highest in human history. Everything rising on borrowed money. This isn't a bull market. This is the everything bubble. And it ends in 2026 to 2027. Welcome to Financial Rewind. I'm here to show you what's coming before it arrives. And today, we're mapping the everything bubble. Why every asset class is inflated simultaneously. How this is different from 1929 and 2008. Why 2026 to 2027 is the breaking point. And how the collapse will be worse than anything in modern history. This is the mega bubble, built over 15 years, by central banks flooding the world with money, and it all pops at once. Let's start with what makes this different. Because we've had bubbles before, 1,929 with stocks, Dow Jones up 500%. From 1924 to 1929, built on margin debt, crashed 89%, but only stocks crashed. Bonds held value. Real estate relatively stable. One asset class bubbled. One popped. 2000.com with stocks again. NASDAQ up 500%. From 1995 to 2000. Built on internet hype. Crashed 78%. But housing stayed strong. Bonds stayed strong. Gold stayed strong. One sector bubbled. One sector popped. 2008 was housing. Home prices up 125%. From 2000 to 2006. Built on subprime mortgages. Crashed 33%. But stocks recovered fast. Bonds rallied. Commodities mixed. One asset class led. Others followed partially. Now look at 2024. Everything is bubbled. Simultaneously, stocks at all-time highs. Housing at all-time highs. Bonds yielding nothing for a decade. Crypto exploding. Art prices record. Collectibles booming. Farmland up. Commercial real estate peaked. Every single asset inflated. Together, this has never happened before. Not in 1929. Not in 2000. Not in 2008. This is the everything bubble. And when everything is bubbled, everything crashes. Here's how it was built. Because this took 15 years, 2008 financial crisis hits. Markets crash. Economy collapses. Federal Reserve responds, cuts rates to zero, launches quantitative easing, buys government bonds, buys mortgage bonds, pumps $4 trillion into system, 2008 to 2014. Other central banks follow. European Central Bank, Bank of Japan, Bank of England, People's Bank of China, all printing money, all buying assets. Global central bank balance sheets explode from $5 trillion in 2008 to $25 trillion by 2020, 5 times larger. Where does this money go? Into assets. Stocks rise, bonds rise, real estate rises, everything rises. Not because of economic growth, because of money printing. 2020, COVID hits. Governments panic. More printing, more stimulus. Fed adds $5 trillion more. In 18 months, fastest expansion in history. Stimulus checks to households, $3 trillion. People stay home, can't spend on services, buy goods instead. And assets. Stocks surge. Housing surges. Crypto surges. Everything surges. By 2024, total global debt, $307 trillion. That's 333% of global GDP. Highest ratio in human history. All of it supporting asset prices. This is the foundation. Built on debt. Maintained by central banks. Inflating everything. Simultaneously. Let me show you the stock valuation. Because this matters. Shiller P/E ratio measures stock prices. Against 10-year average earnings. Smooths out volatility. Shows true valuation. Historical average is 16. Fair value. 1,929 peak was 32. Double fair value. Crashed 89%. 2000 peak was 44. Nearly triple fair value. Crashed 78%. 2008 peak was 27. Above fair value. Crashed 57%. November 2024, 36. Higher than 1,929. Exceeded only by 2000.com. This says stocks are massively overvalued. But there's more. Buffett Indicator. Total stock market capitalization. Divided by GDP. Measures whether stock values match economic output. Historical average is 70%. 1,929 peak was 87%. 2000 peak was 148%. 2008 peak was 105%. November 2024, 205%. Double the economy. Stock market worth twice GDP. Never happened before. Not in 1929. Not in 2000. Not in 2008. Stocks have completely detached from economic reality. And it's not just stocks. Now housing, because this is worse. Home prices normally track inflation, roughly 2 to 3% annually. Keeps pace with wages. Keeps housing affordable. From 1890 to 2000, this held. Home prices matched inflation. Affordable. Then 2000 to 2006 bubble. Prices rose 60%. Above inflation. Crashed 33%. Returned to trend. But then something changed. 2012 to 2024, prices rose 70%. Median home price in 2012, $220,000. Median home price in 2024, $420,000. Nearly double. In 12 years. Wage growth, same period, 35%. Homes rising twice as fast as wages. Now median home costs 7 times median income. Historical average is 3 to 4 times. Housing is twice as expensive relative to income, as it should be. Affordability, worst in 70 years. Worse than 2006 peak. And it's global. Canada up 90% since 2015. Australia up 75%. UK up 60%. New Zealand up 80%. China up 300% in some cities. Everywhere, housing bubbled. Built on low interest rates. Cheap mortgages. Investment buying. Not actual housing demand. Financial speculation. Here's the bond bubble. This one's subtle, but massive. 2008 to 2020. Interest rates near zero. 10-year Treasury yielding 1 to 2%. Investors desperate for yield. Buy any bond, paying more. Corporate bonds. Junk bonds. Emerging market bonds. Prices rise. Yields fall. By 2020, $17 trillion in negative yielding bonds. You pay government to hold your money? $17 trillion. Absurd. Never happened in human history. But it did. Because central banks pushed rates so low, bonds became ridiculously expensive, yielding nothing, or negative. Then 2022 happens. Inflation surges. Fed raises rates, 0 to 5%. In 18 months, bonds crash. Worst bond market in history. Long-term treasuries down 46%. Corporate bonds down 25%. But here's the problem. Rates are back at 5%. Bond prices recovered slightly, but still expensive historically. 10-year Treasury yields, 4.5%. Sounds okay. Until you realize inflation is 3.5%. Real yield is 1%. Historical average real yield is 2 to 3%. Bonds still overvalued. Even after crash, this is the bond bubble, persisting, waiting for next shock. Now crypto, the purest bubble of all, Bitcoin created 2009, worth pennies. By 2017, 20,000, crashed to 3,000. By 2021, 69,000. Crashed to 15,000. By 2024, 98,000. All-time high. What drives this? Not economic fundamentals. Bitcoin produces nothing, pays no dividend, has no cash flow, pure speculation. Value is what next buyer pays. Greater fool theory, and it works. As long as money keeps flowing in, total crypto market cap. 2020, 200 billion. 2024, 3 trillion. 15 times growth. In 4 years. Built on what? Retail speculation. Institutional fear of missing out. Cheap money from central banks. Tether printing stablecoins. Backing questionable. Leverage everywhere. Exchanges offering 100 times leverage. Borrow $1. Control 100. Works great in rising market. Catastrophic when it falls. And the fall is coming. Because crypto is pure liquidity. When liquidity drains, crypto crashes. First and hardest. Every time. Let me show you the debt foundation, because that's what holds this up. U.S. Government debt. 2008, 10 trillion. 2024, 35 trillion. 3.5 times larger? Corporate debt. 2008, 6 trillion. 2024, 12 trillion. Double. Household debt. 2008, 13 trillion. 2024, 18 trillion. Higher than ever. Global debt total. 2008, 120 trillion. 2024, 307 trillion. 2.5 times larger. And here's the key. Debt service costs. U.S. Government now pays $1 trillion annually, just in interest. On $35 trillion debt, at 5% rates, that's 15% of federal budget. Just interest. Not principal. Not programs. Just interest. Corporations similar. Interest coverage ratios lowest since 2008. Many companies barely covering interest. If rates stay here, defaults surge. If rates rise, catastrophe. Households same. Credit card debt at record. Auto loan delinquencies rising. Mortgage payments unaffordable. The entire economy runs on debt. Assets bought with debt. Prices supported by debt. Growth funded by debt. Everything depends on debt staying cheap. But rates are 5% now, not 0. The foundation is cracking. Here's what triggers the crash. Multiple pathways, all converging in 2026 to 2027. Trigger 1. Debt maturity wall. $5 trillion corporate debt matures 2025 to 2027. Borrowed at 2 to 3%. Must refinance at 6 to 7%. Interest costs triple. Many companies can't afford. Defaults begin. Credit spreads blow out. Contagion starts. Trigger 2. Commercial real estate collapse. $2.7 trillion in mortgages. $1.4 trillion matures by 2027. Office buildings 40% vacant. Values down 30 to 50%. Cannot refinance. Banks take losses. Regional banks fail. Systemic stress. Trigger 3. Government funding crisis. Debt ceiling fight. Delayed too long. Treasury can't borrow. Temporary default. Credit rating downgrade. Bond market panic. Yields spike. Everything crashes. Trigger 4. Geopolitical shock. Taiwan conflict. Middle East war expanding. Oil to 150. Supply chains break. Inflation returns. Fed must choose. Crash economy or let inflation run. Either choice triggers crisis. Trigger 5. Dollar crisis. BRICS alternatives gaining. Oil trading outside dollars. Treasury demand falling. Dollar weakens. Foreign holders sell. Yields spike. Assets crash. Any one trigger starts it. All 5 together makes it unstoppable. Timeline 2026 to 2027. When all converge, let me show you the cascade. How this unfolds. Q1 2026. First major corporate defaults. High-yield bonds crash. Credit spreads widen. Borrowing becomes expensive. Companies with weak balance sheets struggle. Stock market corrects. Down 15%. Healthy pullback, media says. Q2 2026. Commercial real estate crisis visible. Major landlord bankruptcies. Banks announce losses. Regional bank failures. FDIC interventions. Flight to safety. Treasuries rally briefly. Stocks down another 10%. Q3 2026. Credit crunch. Banks stop lending, even to good borrowers. Corporate refinancing impossible. More defaults. Layoffs begin. Consumer spending falls. Recession officially starts. Stocks down another 15%. Total 35% from peak. Q4 2026. Panic sets in. Margin calls cascade. Forced selling accelerates. Volatility explodes. Crypto crashes 70%. Bitcoin to 25,000. Everything selling, even safe assets. Gold briefly falls. Stocks down another 20%. Total 48% from peak. Q1 2027. Government intervention. Fed cuts rates to 0. Launches QE. $5 trillion. Doesn't work because problem isn't liquidity. Problem is solvency. Companies are bankrupt. Can't be saved with cheap loans. Stocks fall another 15%. Total 56% from peak. Q2 2027. Real economy collapses. Unemployment hits 12%. Housing crashes. Down 30% from peak. Foreclosures surge. Banks fail. FDIC fund depleted. Government bailouts. Trillions needed. Political crisis. Q3 2027. Bottom reached. Stocks down 65% from peak. Housing down 40%. Crypto down 85%. Unemployment 14%. Worse than 2008. Approaching 1,929 levels. Recovery begins. Slowly, painfully, taking years. This is the pattern. Based on debt levels. Based on valuations. Based on historical precedent. Not prediction. Recognition. Now let's compare to previous crashes. Because scale matters. 1,929 crash. Stocks down 89%. Peak to trough. Unemployment hit 25%. GDP contracted 30%. Took 25 years for stocks to recover. 15 years for economy. But remember, only stocks crashed. Bonds held value. People move to cash. Preserve some wealth. 2008 crash. Stocks down 57%. Housing down 33%. Unemployment hit 10%. GDP contracted 4%. Took 6 years for stocks to recover. 4 years for housing. 2 years for economy. Federal Reserve intervened. Massive stimulus. Prevented depression. Worked. Mostly. 2026 to 2027 crash. Projected stocks down 65%. Housing down 40%. Crypto down 85%. Bonds down 30%. Unemployment 14%. GDP contracts 8 to 10%. Why worse? Because everything crashes. Simultaneously, no safe haven. Stocks crash. Bonds crash. Housing crashes. Crypto crashes. Cash loses value to inflation. Gold might hold, but even gold sells in forced liquidation. Nowhere to hide. That's what makes this different. That's what makes this worse. The everything bubble becomes the everything crash. Here's the Fed's dilemma. In 2008, they had room. Rates at 5%, cut to zero. 500 basis points of stimulus. Worked. In 2020, rates already zero. Couldn't cut further, so they printed. 5 trillion. Worked. Sort of. Created inflation, but stopped crash. In 2026, what do? Rates are 5%. They can cut to zero, like 2008. But debt is 3 times larger. Cutting rates doesn't help. When companies are insolvent, they can print money, like 2020, but they already printed 15 trillion. From 2008 to 2020, balance sheet is 9 trillion. Double to 18 trillion, that's hyperinflation risk. Dollar crashes. Import prices explode. Different crisis. Worse crisis. So Fed faces impossible choice. Cut rates and print. Risk hyperinflation and dollar collapse. Or hold tight. Let markets crash. Let companies fail. Accept depression. Both options terrible. No good choice. This is the corner they're in. Painted over 15 years of kicking the can, of inflating bubbles, of pretending debt doesn't matter. Now it matters. And they're out of tools. Let me show you who gets hurt. Because it's not evenly distributed. Retail investors lose most. Bought at the top. Stocks, crypto, housing. All at peak valuations. Crash wipes out retirement accounts. 401k, balance is halved. Life savings destroyed, like 2008. But worse, because everything falls, not just stocks. Homeowners underwater, bought houses at $400,000, now worth $240,000, still owe $320,000 on mortgage. Underwater. Can't sell, can't refinance, trapped. Foreclosures surge. 10 million homes, young people worst hit. Student debt, high housing costs. Now no jobs. Lost decade begins. Pensioners devastated. Pension funds held stocks and bonds. Both crash. Underfunded pensions become insolvent. Benefits cut. Promised retirements disappear. Small businesses destroyed. Can't get credit. Sales collapse. Half closed permanently. Workers unemployed. Middle class hollowed out. Again. Meanwhile, the wealthy. They have cash. They have access to credit. They buy assets at bottom. Stocks at 35 cents on dollar. Houses at 50 cents on dollar. Wealth concentrates. Further, like every crash before, except bigger this time. Because crash is bigger. Here's what individuals should do. Not financial advice. Pattern recognition. If you're heavily invested, consider reducing exposure. Stocks at 36, Shiller P, E, historically reverts to 16. That's 55% downside. Even without crisis. Just reversion to mean, taking some profits now. Preserving capital allows buying later at lower prices. If you're buying house, wait if possible. Prices 40% above historical affordability. When rates rise or credit tightens, prices fall. Renting might be cheaper, even if uncomfortable socially. Math matters more than timing life milestones. If you hold crypto, understand risk. First to crash, hardest to crash. No fundamental value floor. Could drop 80 to 90%. Again, position sizing matters. If you carry debt, reduce if possible. Rising rates make debt expensive. Recession makes jobs scarce. Being debt-free provides flexibility. When opportunities come, if you're in cash, hold some, but not all. Inflation erodes cash. Diversify into hard assets. Gold, commodities, things with intrinsic value. That can't be printed. And prepare emotionally, because watching portfolio halve is traumatic. Most people panic sell at bottom. Lock in losses. Miss recovery. Having planned now. Prevents panic later. Let me address the counter-argument. This time is different. AI revolution changes everything. Productivity boom justifies valuations. Central banks learned from 2008. They won't let it crash. These are the arguments. And they sound reasonable. AI is revolutionary. Productivity might boom. Central banks did learn. They will try to prevent crash. But here's the problem. Debt doesn't care about AI. 307 trillion in debt requires 307 trillion in repayment, plus interest. No amount of productivity eliminates that burden. Physics doesn't negotiate. And central banks can't print forever without consequences. Already seeing inflation, already seeing currency instability. Push further, system breaks differently. Hyperinflation instead of deflation. Still a crash, just different kind. The this time is different argument has been wrong every time. 1929. New era of prosperity. 2000. Internet changes everything. 2008. Housing never goes down. 2020. Fed has unlimited ammunition. Every bubble thinks it's different. None are. All end the same way, with crash and pain and transfer of wealth from optimists to pessimists, from retail to institutions, from middle class to wealthy. This is the pattern. Repeating. Again. In 1637, tulip mania peaked in Netherlands. Single bulb cost 10 years' wages. Fortunes made overnight. Tulips are the future. Prices only go up. Until they didn't. Crashed 99%. In weeks, buyers disappeared. Sellers desperate. Bulbs worthless. First recorded bubble. In 1720, South Sea bubble. Company stock rose 1,000%. In months, everyone invested. From peasants to royalty. Easy money. Can't lose. Until it crashed. 90%. Fortunes evaporated. Suicides followed. Second bubble. In 1929, stock market mania. Everyone invested. Margin debt at records. New era of prosperity. Stock prices reached permanently high plateau. Irving Fisher, economist, said this. Weeks before crash, down 89%. In 2000, dot-com mania. Any company with .com in name. Stock soared. Pets.com. Webvan. E-toys. Billions in market cap. Zero profits. Earnings don't matter. It's about eyeballs. Until it wasn't. NASDAQ down 78%. Trillions evaporated. In 2008, housing mania. Housing never goes down. Buy now or be priced out forever. Subprime is contained. Ben Bernanke, Federal Reserve Chairman, said this year before collapse. Down 33%. 10 million foreclosures. History doesn't repeat. It reveals, and right now it's revealing, that humans never learn. That bubbles always pop. That this time is different is always wrong. That warning signs are always ignored until too late. Welcome to the everything bubble, the biggest in human history, built over 15 years by central banks printing 30 trillion, inflating every asset simultaneously, stocks at 1,929 valuations, housing at record unaffordability, debt at 307 trillion, all supported by zero rates that are now 5% and rising. The math doesn't work. The debt can't be serviced. The assets can't be supported. The bubble can't persist. 2026 to 2027. Debt maturity walls hit. Commercial real estate fails. Corporate defaults cascade. Credit freezes. Markets crash. Everything. At once. Worse than 1,929. Worse than 2008. Because everything is bubbled and everything will crash. This isn't prediction. This is math. Built on debt. Sustained by printing. Ending in collapse. The everything bubble becomes the everything crash. And most people will never see it coming until it's too late.